hours a day, 7 days a week, 365 days a year. They track the markets. What is it? In the mornings, London is closing, then the US, then Tokyo opens. It's 24 hours. You can trade 24 hours a day globally through the New York, through Tokyo, through London. 24 hours a day. Maybe you don't like to sleep, or you just want to trade, constantly. You can do it if you wanted to. But Bloomberg's really good. It's a great news outlet. Michael Bloomberg, was the mayor of New York, made billions and billions of dollars. He basically built the Bloomberg terminal, which is used by every bank and investment bank and broker-dealer. So it's all the data. If you ever get a chance to do anything with Bloomberg, to learn how to use the Bloomberg terminal, that would be really important for you. Sometimes it's in the job description. Okay, but this is a really good source of information. I do like it. I did hand out The Economist. Did I hand out The Economist to you guys? No? Okay. And The Economist magazine, I think, is really, really good. Did you guys get the Financial Times?
Yeah.
Okay. The Financial Times, The Economist, maybe you can pass these around. Between Bloomberg, The Economist, Financial Times, and Seeking Alpha. Is everybody familiar? It's on the syllabus. Seeking Alpha. Seeking Alpha. Seeking Alpha is really good. If you go and register, you can click on IPOs, mutual funds, ETFs, technology, global. What will happen is you will get a plethora of articles by type sent to your email box every single day. The problem is that if you're not on top of it, your email box is going to blow up because you got too much stuff coming at you. But when I have time, I like to go through those things, check the news, find out what's going on with Alibaba, find out what's going on with Amazon, look at what's happening with the yield curve, look what's happening, who's predicting recessions. They talk about multiple approaches, DCF. There's all kinds of really cool finance stuff there. So if you're interested, go do it, but set up a folder to start dumping that stuff in there because it'll take over your email box. Okay. Let's go through the agenda that I have up here. You guys have received the videos, correct? Pushing them out. You all should have gotten the videos through the announcements. I'm starting to put together the video course log. Let's do the market updates really quickly. What are you using for the market updates to get up-to-date information on the markets? What website are you using? Are you? Okay. That's what I like to use. So if you go up to Yahoo and you go up to Yahoo Finance, you can very quickly, what I like to do is I like to check Yahoo, the homepage first, just to see what Donnie's doing. Because he's obviously all over the internet. And I like to just scan these top stories to see if anything major has happened. If nothing major has happened, then what I'll do is I'll look at the Yahoo Finance page, and I just use this to just check very quickly if there's any headlining or streaming news on interest rates of the Fed, or the stock, what's happening in the stock market or bond market, or if there's some kind of exogenous event that just occurred that we should know about. Here it's going to give you right up in here. You're going to get the S&P 500. Does everybody know what the S&P 500 is? What's the S&P 500? Top 500 companies based on assets, quality, liquidity, float that are traded on the New York Stock Exchange, which is the big board. The S&P 500 is the benchmark stock index that everybody uses to benchmark their performance off of. So if I'm a equity ETF or an equity portfolio manager or mutual fund manager, I'm going to benchmark my alphas. I'm going to calculate my alphas, and I'm going to calculate my betas off the S&P 500 index. Okay. And then the Dow Jones Industrial, that's the one I track because this has been around for like 167 years. And I've been around like 100 years, so I've been tracking it for 100 years. But that's just the one. They're all correlated to each other. So I use the Dow because I just memorize it. It's trading around 25,000, was as high as 26,000. And just kind of put it in perspective, if you go and look at the Dow Jones Industrial Average, and I like to go back to the max, it's going to go back to 1985. So basically, when I first started in the 80s, the market didn't do anything. But by 1995, the market freaking took off, okay? And then you obviously, it went up for years. And then it had the major correction during the financial crisis. And because of over-accommodated monetary policy and keeping interest rates basically at zero for far too long, you've got this major stock market bubble and bull market that is basically still, looks like it's basically still in place. But it's, we're already about 1 year beyond the average business cycle growth phase, and we're well beyond the normal bull cycle. So hold on to your hats. It could be a bumpy ride depending on what happens. And I'll get into some of those dynamics too, which will be reviewed for some of you, and for some of you it'll be all new content. Okay? But reviewing the fundamentals is always a good thing. And then you have the NASDAQ index. The NASDAQ index is made up mainly of what kind of companies? Tech companies. Do tech companies pay dividends? In most cases, particularly newly issued, newly IPO'd, young companies, do they pay dividends?
No, I don't think so.
No, they usually retain their earnings because they need the retained earnings as the cheapest source of capital. They will go out and they'll do an IPO, which they'll raise a bunch of equity, but they usually won't raise any bonds until later, you know, when they're well established. Well, they issue the bonds, and then once they're well established and their earnings, cash flows are established, and they can grow the dividends at a constant rate over time, then they'll start to pay dividends. Microsoft, when they paid their dividends for the first time, I think like 20 or 15 years ago, had a major impact on GDP. Because all of a sudden now, Microsoft was basically providing everybody with these dividends, personal income, growth rates spiked, and then you saw a multiplier effect from the income in consumption and in investment. So these companies, most of them on the NASDAQ are retained earnings. They plow back their earnings because they're fast-growing companies. The stock index, here's a test question, is which one's more volatile? The NASDAQ index or the S&P 500 or the Dow? Which one's more volatile? Which one would have a higher standard deviation? Which one's more risky? Okay, what are the majority of the firms that are listed in the NASDAQ index? What are the companies? Tech. Okay, are tech companies established companies that are non-volatile, that are they hyper-volatile? A lot of volatility in their total returns and their stock prices. So if the NASDAQ is made up mainly of tech companies, then is the NASDAQ index more volatile than the S&P 500 and the Dow? Yes. Okay. Would you, based on that volatility and that risk, would you expect that the NASDAQ expected return or total average annual return over the last 20 years was higher or lower than the Dow and the S&P 500? Do you think that NASDAQ annual returns of the last 20 years were higher, the same, or lower than the Dow and the S&P 500?
In the past 20 years?
Yeah, we'll take 20 years. Over the last 20 years, has the NASDAQ index outperformed the Dow and the S&P 500?
I mean, this is just a guess, but yes.
Yeah, theoretically correct, right? Is there a positive correlation between risk and return? Yes. So if the index is more volatile because it's more risky, because it's made up of tech companies that plow back their incomes, and they don't pay dividends, which means that their share prices and the appreciation rates are more volatile, then yes, the NASDAQ is more risky, and yes, you should get a higher rate of return. So if you're in your 20s, and you have basically 30, 40 years of investment time horizon, as opposed to me, you know, approaching 60, if I had 30, 40 years ahead of me, would I be investing mainly in a NASDAQ-based index or a Dow or an S&P 500? Probably a NASDAQ, because you can stomach the volatility because you have a longer time horizon. You can stomach the volatility. And the rates of return have been higher because they're mostly tech companies. Okay? So that's just some investment logic. Then we have the Russell 2000. We have gold. Gold is trading at around 1,300 an ounce. Right now, it's basically in a trading range for the last 2 years because inflation was low and we had relative stability on a geopolitical level. Currently, we're at the late stage of the business cycle, which means we've squeezed out the majority of the productivity gains that we could squeeze out of labor. So the inflation costs are starting to move up. So people want to go into gold as an inflation hedge, for one. And we've started to see some geopolitical instability. We've seen government shutdown. We've seen trade war threats. We've seen some hostile overtures to North Korea. We've seen some issues in the Middle East. We've seen issues with Russia. Those are all geopolitical events. When people get scared, they move into gold. So gold has basically moved up about $100 an ounce. During the financial crisis and prior to that, gold went through the roof because people were freaking out. Okay? They wanted to be in a safe haven, and they were mainly in bonds and in gold. Okay? So you need to be tracking gold too, and you're going to be doing the memo on it too. Gold prices and silver prices are highly correlated to each other. Looks like the euro to the USD is up, which means that the value of the euro went up, which means the euro appreciated compared to the dollar. So the question then becomes, what caused the euro to appreciate? Do we have any news on that? Because I know that Parliament was voting today on basically the Brexit deal. If they should give Theresa May the permission to basically go to Berlin and go to Frankfurt and go to Oslo or wherever they go to negotiate with the EUs to try to extend the deadline for a hard Brexit in March 1st. So any news on that?
They're wondering if Parliament rejected our motion.
They rejected our motion to go. So that could be something. So we'll see what happens. Okay, let's look at some other indicators. The 10-year Treasury yield at 2.6570. I like to look at the history of the 10-year Treasury yield. There's the history of the 10-year Treasury yield. Can you imagine it was at 18% in the 80s? The 10-year Treasury yield is at 2.6 something right now. It was 18% when I was a kid. If you go look at the last 5 years, you can see where it's gone down, but it's starting to move up. If the 10-year Treasury is going up, what does that tell you about inflation expectations? Okay, what's the Fisher equation? What's the Fisher equation? What is it? What's the Fisher equation? Real rate plus inflation expectations. Okay. So since the 10-year Treasury yield was as low as 1.46 in 2016 and is now at 2.66. So it's over 100 basis points up. So what would cause the interest rates to go up over that time period over the last 2 years? What would be causing the yields on the 10-year Treasury yield to go up over the last 2 years? What? Inflation expectations. It's in the Fisher equation. Okay. So as you start to move into the late stages of the business cycle, and you start to see inflation building in the economy, because you've wrung out all the labor productivity gains, as inflation starts to go up, inflation expectations go up, and it pulls up the 10-year Treasury yield and pulls up interest rates. Okay. Just as long as the earnings on the stock, expected growth rates and earnings expectations, those earnings expectations, growth rates are higher than the rise in interest rates. Just as long as earnings growth rates expectations are higher than the increase in the interest rates, stocks will continue to go up. But if earnings growth rates stop and interest rates continue to go up, stock prices are going to go down. If the earnings expectations go down and earnings growth rates start to turn negative or go down, stocks are going to go down. And the worst case scenario is you have rising interest rates and you have falling earnings growth expectations. That's when stock prices really go down. Okay. So it's those equations, right? I'll go through the equations as kind of a review in a minute. The VIX index. Does anybody know what the VIX index is?
I have a question. You said if the earnings expectation goes up,
earnings growth rate expectations go up, holding the discount rate constant, stock prices will go up. If the earnings expectations go down, holding the discount rate constant, stock prices will go down. If earnings growth rate expectations go up, but they're faster than the rise in the discount rate, then stock prices will go up. But if the discount rates are moving up faster than the earnings growth rate, stock prices will go down. And if earnings expectations growth rates go down and interest rates go up, stock prices are going to be majorly hit. Okay, so you just play with the equation. Right? Okay. It's really the Gordon growth model, and I'll go over that. I'll do that review with you. But does anybody know about the VIX index? Okay, the VIX index, I can trade derivative contracts off the VIX index. I'm trading, yeah, did you have?
So it's expectations of volatility, so when it goes up, people expect volatility, and when it goes down.
Yeah, the VIX index is a measure of stock market volatility. Okay, and so when the index goes up, volatility is going up. When the index goes down, volatility is going down. Okay, so it's a measure of risk in the marketplace. It's a measure of systematic risk in the marketplace. It's a relatively new index, but as you can see from the index, it's 2004, 5, 6, 7, 8, 9. So you can see during the financial crisis, the spikes in volatility, right? And then the volatility starts to dissipate. And then you get spikes in volatility either due to exogenous events or monetary policy shifts. And then as the market starts to mature and calm down, the volatility goes down. So if I'm a portfolio manager and I want to hedge off stock market volatility in my equities portfolio, what would be my derivative trades? I don't want to take on, I got a portfolio, I'm expecting more volatility in my portfolio, I got to hedge off the risk. What derivative trades can I trade on the VIX index so that I can make money that would compensate me for any losses that I have on my underlying portfolio? Go to your memos. Go to your memos. Do you have your memos? Sell short. You? I wouldn't sell short because it's the other way around. So the index actually increases as the volatility increases. So I'm trying to actually hedge off the volatility for my portfolio. So I'm actually going long the index. I'm going long the VIX. So if I'm going long the VIX, I think the VIX index is going to increase and volatility is going to increase. What would be my index derivative trades? This is a test for everybody who took 12023. What would be the, if I'm going to go long the VIX index, what would be my trade?
You buy calls?
I would buy calls. I'd buy calls on what?
Futures.
On the futures contract based on the index, exactly. Okay, what else would I do? Give me another trade.
Right, puts.
I would write puts on the futures contracts based on the index. Excellent. What give me two more? Remember, I'm going long the VIX index. Give me two more. What's it do? What derivative contracts can I trade on indexes?
Right, forwards or futures?
I wouldn't write the forwards and futures. I would, because we're going long, we're not going short. So if I don't write the contracts, I'm going to buy them. I'm going to buy the forwards and the futures. Okay. So if I have a portfolio of equities, and I'm scared that the volatility in the marketplace is going to increase over time, I want to go long the VIX index. To be able to hedge off that volatility in my portfolio, I would buy forwards, buy futures, buy calls on futures, and write puts on futures based on the VIX index. Okay. Do you think people do that stuff? Yeah, they do. That was one of the coolest things by the invention of the VIX index and the ability to basically design futures and option contracts through the Chicago Board of Trade and the Chicago Mercantile Exchange and be able to provide those standardized contracts to investors and hedgers in the marketplace to hedge off the market volatility risk or trade it. Right? Maybe I don't have a portfolio. I just want to trade it. I think the unwinding of the Fed's balance sheet along with rising interest rates is going to cause convulsion in the bond market, which is gonna spill over into the stock market, i.e., I think that the volatility in the stock market is gonna increase significantly over the next 3 to 6 months. My trade would be to buy futures contracts, or buy the calls on the futures, or write the puts on the futures. That would be my trade based on my view. Okay, so we're gonna do a lot of this stuff, right? So you guys need to follow along. I would be taking notes, because I'm teaching you the logic, I'm teaching you the trades. You should be taking copious notes. In all of your classes, you should walk out of your classes with at least 10 to 20 pages of notes. Because if you're not taking 10 to 20 pages of notes, or recording, or typing your notes, you're not gonna remember any of it. You'll probably remember 10%. So you're basically spending all that money to remember 10% of the content. Okay? But if you write that stuff down, you will remember probably 60 or 70% of the content. And then when you take my classes over again, you bring the notes from the prior class and you use them as a reference. Okay? Just make things easier on yourself. Okay, and then there's just currency stuff, need kind of that stuff. So when we do the market updates in class, first thing you do when you come into class is you pull up Yahoo Finance, or you go to bigcharts.com or stockcharts.com, and you get the data, and we basically go through and we get ourselves updated on the market as soon as possible. This is what we do in the real world when we're sitting around in these trading meetings with the managing directors, trying to come up with trading strategies and to come up with an assessment of where our portfolio positions are right now and what are the risks and opportunities that we can take to trade based on the information that we have. Okay? That's the beauty of finance, is you're constantly tracking the markets. The CFOs track the markets every day. The CEOs track the markets every day. The COOs track the markets every day. They want to know what's happening every second of the day. I worked for a company once where the CEO had, basically he had 6 terminals on his desk, okay, like the 6 terminals. He had his portfolio position, he had a REIT dashboard, he had internal operations, he had financial operations dashboard, he had all these dashboards. He was like a fighter pilot running a multi-billion-dollar corporation, monitoring everything at all times, so that when an opportunity or something happened, he could totally respond with his team to either take advantage of it or mitigate the risk. And the one time that I thought was totally amazing is that all of a sudden he decides that we're going to issue $250 million worth of equity right now, because it had already been registered through the SEC and was sitting on a shelf. So he basically calls the investment banker and says, I want to trade, I want us to issue $250 million of BRE stock at $29. Can you guys do it? Yes, we're not going to do a best efforts, we're going to do a firm commitment as the investment bank. We're going to take the full $250 million issue, give you the money after the float and the fees, and basically that's it, you get the money, boom, and we'll take care of the selling off the $250 million of the issue. Said, wow, that was pretty bold. And then all of a sudden, within 2 days, the stock price went to $22 from $29. We pocketed it, and the investment bankers were stuck with the inventory. Okay? It was a brilliant maneuver by the CEO to do it, and we did it, and we pocketed the money, and we got really cheap cost of equity on that issue. Okay, so we're always monitoring these markets, looking for opportunities. Okay. Chapter presentation. So, am I doing? Was there a team 1?
No.
No. So I'm team 1. And then team 2. Are you guys ready? Team 2, asset classes, financial investments. Do I have to look it up on my phone? Team 2.
No, we're not ready yet.
Okay, you're going to do it on Tuesday. What about team 3? Team 3, securities trading. Okay, Tuesday? Yes, okay, and then how long are these presentations?
15 minutes.
Yeah, 15, 25 minutes, edit them down, get to the point, study the chapter, study the PowerPoint presentation, come in, talk from the slides, use the slides as basically talking points to pace yourself through the presentation, try not to read from the slides, okay? Do the best you can, so be prepared to make the presentation. was thinking about making all the presentations formal dress, business dress, because last semester I had some people coming in jeans and, you know, I don't know, I think their pants is maybe backwards, down, and they're like, you know, presenting and stuff like that. I don't think I will do that, but when you make the presentations, please imagine that you're making the presentations to an investment committee, okay, or a board of directors. So start practicing the presentations, because I just read the other day that the 3 skill sets that the employers are starting to look for the most now, that they're really looking for, yes, they like your technical skills, your Excel and all those things, but they're looking for communication skills. Presentations, writing, and leadership. Okay, so now they're moving away from really the technical competencies to the soft skills that become more valuable when you're dealing with clients and you're dealing with individuals on your teams and stuff like that within the company, which I think is pretty fascinating. Let me do an introduction to investments. Okay, there's going to be some overlap between 123 and 135 and the investments. They're related courses. Okay, so there's a lot of overlap between my courses, and I'm not convinced that people who've taken my 123 have totally ingrained all of the foundational work, so that by the time you take this course again, I can't assume that you remember that stuff. I gotta go back and I gotta remediate a lot of the stuff that you've already learned, because I don't think you remember it, okay? I get some complaints from students that say, oh, it's just like 123, but I'm not convinced that they remember everything from 123. So I gotta go back and spend the first part of this class reviewing a lot of that stuff, which is the foundations, that then to be able to move forward to do the application. Yes, sir.
Just for clarification, the presentations, like, we're just pulling up the slides and like
Yeah, but I would
explaining
just
the
pull up
PowerPoints?
the PowerPoint presentations and work through them, edit them down, maybe add in some newer data or information, maybe put some of your own insights into it. Use the PowerPoint presentation as a foundational deck, and then spend a couple days on it, you know, and try to clean it up and make it better. Because the book presentations, I don't think are very good, they're too wordy. You know, they don't get to the point, they kind of get to the point, but they don't get to the point. And I think you can get to the point probably quicker.
Okay.
Okay. And I'm really more interested in bullet points and the mathematical equations. Because we need to memorize those mathematical equations in our brain, so that they flash in front of us when we're making decisions and we know how to model stuff. Okay. All right, so let me do an introduction to investments. And I might run back over there because I just did 123, so some of the stuff from this class I did in the last class, and I can use those models to basically explain. So introduction to investments. So we had 123, which was basically financial management. In investments, there's really 5 courses in the finance core. You got corporate finance, you should have an intermediate corporate finance. You have investments, you probably have international finance, and then you probably should have a derivatives class, okay, or financial engineering in a financial institutions. Okay, that's kind of the curriculum within the core finance concentration. If you read my syllabus, the syllabus is basically, when I wrote that syllabus, I already did a master's degree in finance, I did an undergrad, I did econ, I did the doctorate, I wrote the syllabus that basically gives you all of the information and all of the models that you should be familiar with from your finance concentration. So the syllabus is actually a primer for you. I would read it, okay? I spent a lot of time writing it. It's really, really good, okay? So if you're into finance, read the syllabus, okay? Read it. It's really good. It'll help you a lot, okay? So investments, finance is a technology. Okay? Finance is technology, in my view. Finance is a technology. Let's take the technology to basically take the data, do the market research, to basically apply the mathematics, to design the process, to design the products, to solve the problem, and those products, stocks, bonds, derivatives, synthetics, whatever it is, those products then become the solutions to solve problems in finance. So finance is technology. The products are technology. The products are tools that solve problems. Financial engineers and quantitative finance people, along with the marketing people, have identified problems in the marketplace. Have gone back to their financial engineers and their product developers and said, here's the problem. Use the existing products that are available in the marketplace and synthetically solve the problem using the existing products, or invent new product to solve the problem. That's what we do. Okay? That's what we're going to do in this class. That's what I do for a living, is I solve problems by taking existing products out there, piece them together to solve the problem, or I invent new products to basically solve the problems. Okay? So the tools, the technology that are standardized, and once they're standardized, and once they move through the early to the majority adoption phase in the capital markets, a capital market is then developed based on those securities. The investment banks, in most cases, design these products, introduce the products, sell the products, get the products adopted, and then trade and manage the portfolios of the products. Okay? So they're basically vertically integrated companies, all the way from manufacturing to distribution, okay? And then maintenance afterwards. So stocks, which are also called equities, are just standardized units, standardized contracts that are basically designed by securities attorneys that have already been standardized, that basically are claims on the ownership of the company by the different classes of ownership, by the different classes of the stocks. They're standardized, and the company, once it decides to go initial public offering and registers the securities with the SEC, basically becomes a listed company on the exchange, and then the stocks start to trade on the exchange. And as the company starts to issue more shares, because it needs more capital to expand its operations and plant equipment and to go global and to develop new products and marketing, then their market cap increases significantly over time. And then they'll eventually start to issue at some point, they'll start issuing fixed income securities or bonds. Fixed income securities and bonds are standardized units, standardized contracts. It's a legal contract. These are issued to investors. They trade in the over-the-counter market. They do not trade on exchanges. And you can issue and you can buy fixed income securities of different types of maturities depending on the type of entity, i.e. government, municipality, or corporation. So you have equity and you have debt, which makes up the majority of the liability side of the balance sheet that finances the assets. Okay? And you want to match the maturity of the liability with the asset life. Okay? Short-term liabilities finance short-term assets. Medium-term liabilities finance medium-term assets. Long-term liabilities finance long-term assets. If you start to finance long-term assets with short-term liabilities, if interest rates move against you, before you know it, you got higher liability costs of capital than you do on total return on your assets. You got negative arbitrage. You got negative economic value add. You got negative spread. You're going out of business because you didn't manage your balance sheet correctly. And a lot of companies have gone out of business because they did that. Okay? Commodities, gold, oil, silver, real estate is a commodity, but it's not, there's no derivatives and there's no indexes to trade that. We'll do that in the middle of the semester. The midterm will be all around my doctoral dissertation on building indexes. So I'll show you how to build indexes. Build real estate indexes to launch the property derivative market. I've done it. I'm doing it right now. It's the greatest thing ever to build product, index product, to launch a capital market and then sell that product in the market and create a market. Okay. Commodities. And I can trade forwards, futures, and option contracts and swap contracts on commodities too. I can trade derivative contracts on currencies. I can swap currencies in a swap contract. I can do interest rate swaps where I swap forward for fixed. If I'm a multinational corporation and I have a comparative advantage in either floating or fixed marketplace, I can swap with another corporation and we both lower our overall cost of capital by swapping floating for fixed. So I can do that on the commodity side. The investment books are limited because they're written by corporate finance people. They're not written by multi-asset portfolio managers like myself. So they don't include the insurance products and the annuity products. They don't even talk about them really. But insurance and annuity products are huge. The mutual insurance companies, which are owned by policy owners for these whole life policies, these permanent life insurance policies, these mutual insurance companies have no debt and they have no equity. Their cost of capital comes from their insurance policy holders. So they're ultra conservatively leveraged. When I worked at New York Life, the company was worth about $800 billion in assets. If it was a publicly traded company with debt and equity levering up the market cap, the company would have been worth $3 trillion. But they decided they wanted to keep themselves as a mutual insurance company and not a Sears of financial products and services. They wanted to have all of that conservative balance sheet because they wanted to make sure that when the financial crises hit and the recession hit, that they were conservatively leveraged, they had enough liquidity to be able to pay off the policy holders that were borrowing or cashing in their policies because they were running out of money because they needed to make their mortgage payment because they lost their job. So they had enough surplus reserves, they were totally conservatively balance sheet, and they could handle 3 major crises on their balance sheet and get through it. Most of the large insurance companies, other publicly traded companies can't do that, and the publicly traded banks couldn't do that. They couldn't even get through the financial crisis without having to go to the Treasury to get bailed out, and bailed out by the Fed. So these insurance companies are bulletproof. These insurance policies are bulletproof, and the annuity contracts are bulletproof too. And actually, New York Life invented a guaranteed future income annuity product and a variable annuity product that basically guaranteed that you would lose no money if you bought those annuity contracts. The fees were pretty high, but people could sleep at night knowing if there was another financial crisis, I wasn't going to lose any money, because that's what people were freaking out about. So they invented the product in 2011, the guaranteed future income annuities. Within a year, they controlled over 50% of the market because they were the first mover, and to this day, they still own 40% of the market. First mover, early majority adoption, capture, and keep market share. They were brilliant. Derivative contracts, engineered product, financially engineered product. I got basically a securities contract that basically trades on some index or some underlying asset, okay? So I can basically buy or write a futures contract. Let's use the option contract. I can buy or write a put or a call option contract on a futures contract based on the underlying index. So I can trade on gold, I can trade on oil, I can trade on anything using derivatives as opposed to having to buy and sell the underlying asset. The key here, you need to write this down. The key here is that the futures, the option prices and the futures prices and the underlying index movements are correlated to each other, but they're not perfectly correlated. There is what is called basis risk. Basis risk. So the index may drop, 10%. The futures contracts will drop maybe 15%, and the options contracts will drop 20%. So they're correlated to each other, but there's different volatilities because there's different underlying bases. Okay, the option contracts are based off the futures prices. The futures prices are based off the indexes. So there's no perfect movement. The lack of perfect movement is called basis risk when you're trading derivatives. Derivative products, swaps, swaptions, options, futures, forwards, exotic options, all these permutations of these derivative contracts can also be pieced together. I got a problem. There's no product to solve the problem. But I have other products that are available out there. So what I'm going to do is I'm going to take this product from here, this product from here, this one from here, and I'm going to put them together, and I'm going to create a structured product out of it. It's It's a synthetic, okay? Synthetic. I can take the derivatives, I can piece them together, I can create structured product, I can sell those structured products to my investors. I can take different products, derivative products, I can piece them together into synthetics, okay? Synthetic solutions. Synthetics is customized assemblage, okay? Structured products, assemblage, standardization, I sell that as a product to my investors. Do you understand? Are you guys getting this? This is financial engineering, financial innovation, okay? The finance is a technology, investments are a technology, the securities are the tools to solve problems. People invent these products, okay? They invent these solutions. And now what they're doing is they're combining the technologies around the securities with technology as fintech companies. So these are tech companies moving into the finance space to basically create products and services to disrupt the financial institutional framework. That's pretty exciting, actually. Okay, and then real estate. I can buy real estate in many different forms. I can buy direct, go out and buy all cash, buy a house. I can buy commercial property. If I wanted to, I could buy the mortgage loans that are being applied to the real estate. So I have first claim. If they default on the loan, I take the property. So I can buy mortgages, first mortgages if I want to. I can buy second mortgages. I can buy into a first commercial mortgage pool if I want to, into a fund. I can buy into a pool of second mortgages collateralized by the underlying real estate. I can buy into a pool of second mortgages. I can buy into a crowdfunding platform where if I'm a accredited investor, I can invest in mortgages and real estate through crowdfinancing if I'm an accredited investor and get real estate exposure. I can buy commercial mortgage-backed securities, which are basically institutional grade securities that are basically tranched out just like corporate securities that are backed by commercial mortgages. I can do that too. I can buy residential mortgage-backed securities, which are basically securities backed by a pool of residential mortgages. I can do that too. I can buy into mutual funds. I can buy into ETFs as products to gain exposure to the real estate market. I can buy real estate investment trust shares. I can buy their preferred shares. I can buy their bonds if I want to get real estate exposure. Nobody ever talks about any of that stuff. And a while back, I developed a series of real estate indexes with Standard & Poor's, and the Chicago Mercantile Exchange launched the futures and option contracts based off of those indexes so that people could trade off of commercial real estate using derivatives and not having to buy the underlying real estate, which is extremely expensive. That product failed. It's non-existent. But there is a product on the Case-Shiller Index, which is the residential housing index, sponsored by S&P, and the derivatives do trade on the Chicago Mercantile Exchange. So I can trade San Francisco Bay Area home prices using futures contracts and option contracts on the Chicago Mercantile Exchange. So if I think that the home prices are going to fall over the next 3 to 9 months, I could be buying the puts, or I could be writing the calls, or I could be writing the futures contracts on this to basically make that bet. Okay? So there's a ton of stuff out there. We didn't even talk about collateralized debt obligations and other types of products. There's all kinds of products out there that solve problems. Some are good products, some are bad products. A lot of people like to invent these products to go out and try to get the money, get the fees, make the market, and when the market blows up, the product blows up, and all the investors then lose their money. That's horrible. Okay? So when you're underwriting these securities and you're investing your clients' money on their behalf in these instruments, they have to not only be theoretically correct, but they got to be sound instruments, they got to be backed by a good sponsor, they got to have liquidity, they got to have standardization, and the market's got to be resilient and they got to last. Okay? I don't like to sell flawed product backed by a flawed financial institution. Okay. So when you approach the pricing of these instruments, I start at the macro level. I look at macroeconomics, macroeconomic policy, fiscal policy, monetary policy, interest rate determination dictated by the Federal Reserve, using open market operations as the tool to basically regulate interest rates up and down through the Federal Reserve open market operations through the Fed out of New York. So the Open Market Committee gets together, they vote on interest rate policy. They think that inflation is getting too high. What they're going to do is make a recommendation to raise interest rates. So they will allocate or tell the Fed in New York to sell X amount of Treasury securities that will cause the Treasury bond prices to go down and interest rates to go up to cool the economy. Okay, that's how basically it works. I'm really focused on macro policy and monetary policy and what the Fed does, because my analogy is the Fed throws a great party. We all go to the party, the Fed's get spiked the punch, we're all drinking the punch, we're getting drunk, we're having a great time, everybody's happy, everybody's partying, everybody's having a good time, and all the Fed says, I gotta go. Takes the punch bowl and leaves. Now everybody's like, what's going on? We were just getting started. Now I'm depressed, I'm losing money, I'm not happy, I'm hungover, and we're just saying, when's the Fed gonna bring back the punch bowl, and when are we gonna have another party? So the Fed basically dictates what the markets do, okay? That's why every word, everything the Fed does, the market watches it. If you can figure out what the Fed's gonna do, what the impact is gonna be on these securities going forward, you can set a strategy and a trading strategy, and you can accumulate wealth, or you can make money based off of these trades, based on recommendations to your clients and your proprietary trading units. Okay? So when they determine interest rate, they use the Fisher equation. What's the Fisher equation? Yeah, nominal interest rates equal real rate
Plus inflation.
plus inflation expectations. Got it. Real rates don't really move that much over time. They move cyclically or secularly, but they're basically constant in the short run. So movements in nominal interest rates are driven mainly by movements in inflation expectations. And inflation expectations are highly correlated to the overall business cycle. So if we're coming out of a recession and we're moving into the growth peak phase, then there's going to be positive inflation expectations. This is going to be positive, okay? And this is going to be higher. And the yield curve is going to be upward sloping. So we start moving into a decline phase, or into the trough or the recession. Prices are probably going to slow, or probably going to fall. This is going to turn negative. Interest rates are going to turn negative, and you're probably going to get an inverted curve. Okay, and I'll go through that in a minute, because I do believe that yield curves and yield curve dynamics, the yield curve is the number one thing that determines the price of all debt and equity securities. All debt and equity securities are priced off the yield curve. So if you want to figure out where the price of debt and equity securities are going to go, you gotta look at the yield curve, okay? And you gotta understand the yield curve dynamics, and you gotta understand the yield curve theory, okay, to be able to understand that. Because the yield curve, Fisher equation, and the yield curve determines discount rates. And what's the discount rate? Well, the discount rate could be your expected rate of return. The discount rate could be the cost of the equity using the capital asset pricing model. What's the capital asset pricing model? You have computers, you can look it up, you can look it up on your phone, you can look it up on your tablet, you can look it up in your book, you can look it up in a chapter, you can ask your friend. You need to memorize this. The capital asset pricing model equation determines the cost of the equity or the expected return on the equity. So if I'm a company, I use CAPM to calculate the cost of the equity. If I'm an investor, I use CAPM to calculate the expected return on the investment. So what's CAPM? Yeah, what is it? What's the equation? Go for it.
Expected return equals
Okay, that's the expected return is the CAPM right there. That's your return on your equity. Equals what?
risk-free rate
It's the risk-free rate
plus
plus
open parentheses, beta,
beta,
multiplied by market risk premium, close
the
parentheses.
return on the market minus the risk-free rate. This is the market risk premium. This is called the market price and risk. This is the discount rate. So this is my IE. So if I'm gonna, this is gonna be CFOT plus 1, where CFO equals earnings per share, dividends, EBIT, per share, or some other metric. Okay. So this is this. What happens to, and this is the value of the equity. So if risk-free rates go up, what happens to the discount rate? What happens to the cost of the equity? If risk-free rates go up, what happens to the discount rate of the cost of the equity?
Goes up.
The risk-free rate goes up, this goes up. And what happens to the value? Goes. This goes up, this 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 goes. You only have two answers, up or down. If this goes up, this goes. If this goes up, this goes. Say it, I can't hear you. Down, got it, okay. This goes up, this goes up, this goes down. What happens if the beta goes up? What happens to the discount rate, cost of the equity? The beta goes up if the systematic risk in the market or the market risk goes up. What happens to the discount rate? If this goes up, this goes up, this goes down. If the market risk premium goes up, what happens to the cost of the equity?
Goes down.
If this goes up, market risk premium goes up, what happens to the cost of the equity? If this goes up, this goes up, this goes down. Got it, okay? Now, if the risk-free rate goes down, what happens to the cost of the equity? It goes down. What happens to the value of the equity? It goes up. Got it. What happens if the beta goes down? What happens to the discount rate and the cost of the equity? The beta goes down, the discount rate or the cost of equity goes down. What happens to the value? Up. What happens if the market risk premium goes down? What happens to the discount rate or the cost of the equity? Goes down. And what happens to the value? Goes up. Got it? Okay. Got it. Weighted average cost of capital. You guys remember that one? Can I use the weighted average cost of capital as the discount rate for valuing securities, valuing properties, valuing corporate entities, valuing companies? Can I use the weighted average cost of capital? If I'm the acquirer and I'm buying a company, would I be using our weighted average cost of capital as the discount rate to discount the cash flows to figure out the value? Would I do that? Say it.
Yeah.
Yes, that's how we do it. Okay. So what's the weighted average cost of capital? Click, 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 click. Search, 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 search. Look it up. You will find the answer at your fingertips. What is it? Oh, Megan, you memorized this, didn't you?
Cost of equity times percent of the equity
Exactly. The weight of the equity, got it. The cost of the debt.
plus
Oh, yeah.
times 1 minus tax rate.
Yeah, because aren't you able to deduct the interest on the bonds? Right? Aren't you able to deduct the bond interest? Yes. Can you deduct the dividends that you pay on the stocks? No. Can you deduct the interest that you pay on the bonds? Say it.
Yeah.
Yes. So would that make it a tax shield? Would the being able to deduct the interest on the bonds create a tax shield? Yes, it would. Okay. Okay, and then what else?
plus cost of preferred stock times
Oh,
percentage.
yeah, I'm not, yeah, okay. You don't forget the preferred stock, but nobody uses preferred stock that much. Okay, anything else, Megan? Is that basically the equation?
Yes.
How do you calculate the cost of the equity? What equation do we use? We just did it. Just say it. How do I calculate the cost of the equity? We just did it. What equation do we use? We just spent like the last 10 minutes going through it. What is it? Cap M, got it. So cap M, this is cap M over here. Right there. How do I get the cost of the debt? How do I calculate the cost of the debt? I can use the yield to maturity. I can go out and look at the bonds that are currently traded in the marketplace and calculate the yield maturity on them and use that as a proxy cost of debt. I can go back and look at the disclosures and the financial statements and look at the cost of the debt when they were issued. I can do that too. I can go and look at other companies that have issued debt similar to ours and look at their cost of capital and get that as a proxy cost of debt. So there's a bunch of ways to get the cost of the equity. And then what are these weights? What are these weights? Weight of the debt, weight of the equity. Isn't this your balance sheet? Right? You got your assets, you got your liabilities, you got short term, medium term, long term. What makes up the long term? We got long-term bonds, and we got owner's equity. Got it. So basically what you're gonna do is you're gonna add these up right here. Okay, add these up and then divide them back and get a weight. Most corporations, mid-cap companies, traded on the New York Stock Exchange, if you look at their capital structure, they usually have 70% debt and 30% equity. Most don't lever up more than that. Maybe they do 60-40, or the REITs do 50-50. But most companies are 70-30 in their capital structure in how they finance their long-term assets. Okay, and that becomes the discount rate. I can also use the expected rate of return as the discount rate. I can say I want a 20% rate of return. Okay, great, 20%. I'm going to use that as basically the discount rate to get the valuation. So I can use CAPM, I can use WACC, I can use an expected rate of return to determine the discount rates that I'm going to use to apply to these securities to get the intrinsic values. And if the intrinsic values are higher than the current price of these securities, I'm going to buy them. I'm going to arbitrage. And if I run the analysis and the intrinsic values are lower than the current price, I'm not going to buy them because the values are lower than the current price. It costs me too much. Okay. Any questions so far? That's just discount rate determination. Once we get the discount rates, now we can apply the 4 intrinsic valuation methodologies to come up with the value of the bond, the stock, the real estate, the company, whatever it is we're investing in. Perpetuity model is pretty straightforward. It's just your cash flow next year divided by your discount rate. Expected return, CAPM if it's a stock, could be the cost of the debt if it's a bond. That's just the basic equation. Okay, so it's very simple, and you assume that the cash flows are going to remain flat into perpetuity. That's why they call it the perpetuity model. So it's a very simplistic, easy way to get to some intrinsic value very quickly. Okay, particularly for a stock or a piece of real estate. If you're valuing stocks, you're going to use earnings per share. You might use EBITDA per share. If you're using a piece of real estate, you're using the operating income. If you're using an established corporation, you're using earnings. If you're using a startup company, you're using EBITDA to value the company. So it depends on what you're valuing is going to determine what the numerator is, and really what the denominator is too. But the valuation structure is basically the same. And then the Gordon growth model is basically the perpetuity model. CFO T plus 1 divided by I minus G. And the Gordon growth model just basically states But the G assumes that the cash flows are gonna grow at a constant rate forever. In the perpetuity, they're gonna remain flat into perpetuity. For Gordon growth, they're gonna grow at a constant rate into perpetuity. So it's basically next year's cash flow divided by I minus G. Will give you a more realistic intrinsic valuation for the security, although it's still very simplistic. It's more accurate because it assumes that the cash flows are gonna grow at a constant rate. So if you're looking at Salesforce or Amazon or one of those tech companies, Netflix, would you be using the perpetuity model or would you use the Gordon growth model? Do you think those tech companies, earnings are gonna grow at a constant rate forever, or do you think they're gonna remain flat? They're gonna grow at a constant rate, so Gordon growth is more than appropriate methodology for tech companies that have good growth prospects going on in the future. IBM and other established companies really haven't been able to grow their earnings for quite some time because they're basically in the mature phase of their company cycle, the industry cycle, the product cycle, they're not going really anywhere. So the perpetuity would be a more appropriate model. The next model is the multiple approach. The multiple approach, and I'll go into more detail on this. Wes, you might want to bring that over here. So the multiple approach equals your cash flow, T plus 1. This is next year's earnings per share, or dividends, or EBITDA, or free cash flow, whatever it is. You're valuing the stock, or you're valuing the firm, or you're valuing the real estate. You're always going to use next year's cash flow. Then you're going to multiply it by some multiple, next year's multiple, to get the value of the share of the company using the multiple approach. Okay? Now the question is, what's the multiple, right? So if I'm valuing if I'm using earnings per share, T plus 1 times price divided by earnings per share, this is called what? Stock price divided by the earnings per share is called what? What's it called? PE multiple? Got it. So if I can forecast the multiple in the future for the company and apply it to the future cash flow, I can get the future value of the company or the future value of the share. Okay? I can go out and I can find company 1 multiple, company 2 multiple, company 3 multiple. I can go find 3 companies similar to ours in the same sector, targeting the same clients with the same type of products in the same phase of their development and the same phase of their production, and I can go get their multiples and look at them as a range. So maybe it's 14, 13, 12, 13. So I get the earnings per share next year for my company. I multiply it by the 13 times compared to the peer group. I'm going to get the value of my company using the multiple approach, using the comps. That's another way I can get multiples. I can also, if I'm doing the firm, if this is just earnings, what I can do is I can go get a multiple. So what I can do is I can find the value, or I can find the sales price, divided by the earnings. And I can also use EBITDA. So it's basically the value of the company, or the sales price of the company, divided by the total earnings or the total EBITDA of the company that we're looking at as a comp. And I can get a multiple. And there was 3 of these, 3 companies that sold just like ours last year. And I know the sales prices, and I know what their earnings and their EBITDA were. So I can calculate the multiple from those 3 companies. And I can apply the multiple here to our earnings or to our EBITDA to get the value of our company using the comps, using the the comparable sales that occurred in the marketplace. So I can do it that way too. I can also create a multiple. This should all be pretty much review for you guys. I can create a multiple by doing 1 divided by the discount rate. I can also create a multiple by doing 1 divided by I minus G. So I got multiple methods to create multiples, to then be able to do sensitivity analysis to come up with the value of the company or come up with the value of the share. Okay, everybody follow along so far? Okay. This is all reinforcement. Okay. How am I doing on time?
Got about 20 minutes.
Okay. The discounted cash flow, value DCF, equals, I'm gonna do a 2-period model. CFO T plus 1, CFO T plus 1 equals CFO T equals 0, right? Times 1 plus G. So I got last year's cash flows, I'm gonna grow it out to get this year's cash flow, or next year's cash flow. Got this year's cash flow grown out to next year. This is gonna be year 1. And year 2. I'm gonna grow out that cash flow, 1 plus G, and I'm gonna get CFOT plus 2. Got it, so I got my yearly cash flows. This is a 2-year holding period. We're a venture capital firm. We're a turnaround firm. We go in, we buy companies, we restructure them, and then we sell them at the end of 2 years. Okay. So the first 2 cash flows, I'm going to discount them back at my discount rate. And if I'm a venture capitalist or I'm a turnaround expert, I'm probably going to be using maybe 20% to 40% discount rates, which these actually turn out to be 0.2 or 0.4, and the discount factors will be 1.4 or 1.4, something like that. Okay. So now we've got the numerators, we got the denominators, we got the cash flows over the 2-year holding period. I want to sell the company at the end of the 2 years. Okay? How do I get that intrinsic value? How do I get that terminal value? So what I got to do is I got to grow out year 2, 1 plus G, to get CFOT plus 3. Got it. Then what I'm going to do, if I think that the cash flows are going to remain flat forever, I use the perpetuity model. If I think that the cash flows are going to grow at a constant rate forever, I use Gordon growth. If I do this calculation, I'm going to get the terminal value. I take the terminal value and I add it to the last year's cash flow. So the terminal value plus the last year's cash flow added together, discounted back at the discount rate, 1.4 squared. I get a discounted cash flow number here. Discount back this cash flow, I get a discounted cash flow number. I add them together, I get the intrinsic value, or the present value, and the future cash flows. So I can use this model. This is the super growth model, 2-stage growth model to value securities, or I can use this to value the company. I can do that too. Okay. But where the students get confused, one is you take this year's and you grow it out to next year's cash flow, and you grow it out again, and then you grow it out one more time over here. And then what they do is they forget this piece. So after you grow it out to year 3, then you apply either perpetuity or Gordon growth to get the terminal value. You take the terminal value, you add it to the last year in the holding period's cash flow, you discount it back to get the discounted cash flow, then you add up all the discounted cash flows to get the present value or the intrinsic value of the share or the company. Okay? Everybody clear on that? That's the DCF model. Okay, so those are the 4 intrinsic valuation methodologies that you would do to pretty much value anything. When you're valuing derivative contracts, like option contracts, you're gonna use Black-Scholes or binomial tree. Those are just a different type of calculus. This is pretty straightforward as a fundamental approach to intrinsic valuations. Okay, how am I doing on time? Okay, perfect. I'll finish just the introduction today, and then we'll have to do the presentations on Tuesday. Okay. So once you've gone through this step, you know, of the macroeconomics, monetary policy, yield curve dynamics and determining the interest rates, interest rate determination and intrinsic valuations, using the 4 intrinsic valuation methodologies to be able to value the real estate or value the firms or value the stocks. Now you can start building portfolios. Okay, portfolios of stocks, bonds, real estate, derivatives, whatever it is. Now we start moving into portfolio theory. Okay, modern portfolio theory, postmodern portfolio theory. Okay, I'm a big advocate and a big proponent of postmodern portfolio theory, although it's never mentioned in the book anywhere. Okay, so the book isn't even interested in it. Okay, I've never really heard anybody talk about it. So there's modern portfolio theory and postmodern portfolio theory. Harry Markowitz in 1957 wrote his doctoral dissertation and won like a Nobel Prize. At some point in the future, he invented modern portfolio theory. You will be applying modern portfolio theory in the second Excel project that you will be working on. On Tuesday, you're going to come in, we're going to do the presentation stuff, but we got to get the lab going. You got to talk to your teammates. You got to come up with a portfolio strategy. You got to pick 25 stocks. You got to start getting the data into the Excel spreadsheet. Okay, and I'll walk you through that on Monday. But you should come on Monday with a portfolio strategy, 25 stocks. What I would do is I would pick how you want to diversify the portfolio. I want a all tech stock. I want 25% hardware, 25% software, 25% social media, 25% networked exchange, you know, like an eBay or something like that. I want 25% tech, 25% defense, 25% medical tech, 25% something else. What's your strategy? You know, you're going to have all large cap stocks. Are you going to have some large cap with some mid caps? Are you going to have large cap, mid cap, small caps? Are you going to have all small caps? What's your strategy? Who are you targeting your portfolio to sell it to? You to sell it to retail investors or institutional investors? Risk averse investors or risk neutral investors? People who are looking for high return or people who are looking for high risk adjusted rates of return? Who are you selling this strategy to? Okay, so you need to kind of think about that. Or do you do a defensive strategy? I want all consumer defensive products. I want toy companies. I want Procter & Gamble, Johnson & Johnson. I want companies that are going to be defensive through the recession, and we're going to sell a defensive, recession-protected ETF or mutual fund or single account portfolio strategy to our clients. Maybe you want to do that. Okay. So Markowitz basically came up with the modern portfolio theory. We're going to apply his stuff. Index portfolios, passive portfolios, smart beta portfolios. These are the rages. This is what BlackRock, you know, got its trillions and trillions of dollars on. Franklin, Vanguard, Schwab, all of those guys have come up with smart beta, passive indexed portfolios. Why would I try to buy all of the stocks in the S&P 500 to replicate the index when basically I can go buy a S&P 500 replicated indexed exchange traded fund? Why do it yourself now? Now you can just buy the product through the company that invents this stuff. And maybe we'll factor tilt the S&P 500 and factor tilt it towards faster growing companies, or factor tilted toward more defensive types of companies, or factor tilted towards, give more weights towards mid cap and small cap companies within the S&P 500. That's what these smart betas are. So basically I come up with the allocation, the weights for the S&P 500, and I start tilting the weights, tilting the factors based off some kind of smart beta style, some kind of strategy. Okay, I'm doing that right now. I'm building an index, right, for real estate right now. I'm gonna replicate the real estate index against the REIT index. Boom. I've just replicated the underlying real estate market with the REIT market. Boom. That's one strategy. So this is where all the product innovation is coming, but they're passive indexed models with smart beta factor tilts is what they're doing. So they'll come up with the initial weights, and then they'll tilt the weighting scheme towards some kind of smart beta or some kind of style within the portfolio. You can be really creative about this. Okay? Then the dynamic portfolio strategy, the active portfolio strategy, the dynamic portfolio strategy is the portfolio optimization. And as you start to work through the book, and I give you the take-home exams and stuff, you're gonna go through the book, all this stuff, and all the math is already laid out for you. And I built expanded the Excel spreadsheet to be able to teach you how to run these optimizations based on the covariances of the returns and trace out the efficient frontier. And then pick the portfolios that you want based on risk and return that you're gonna sell to your clients. So if we do this right, we can sell this strategy, we can sell this one to our clients, and we probably have 3 of these that we can sell to our clients too. If we factor tilt these things, I got 3 passive portfolios I can sell. If we run these along the efficient frontier, I can pick 3 along the efficient frontier that I can sell to my clients. Now I got 6 portfolios. And if I can raise $2 billion each on the 6, 2, 4, 6, 8, 10, 12 billion, you're talking $12 billion. If I make 1 point on $12 billion assets under management, dude, you're gonna be living in Tiburon, okay? You'll be living in Tiburon. So again, that's how they do it. They invent these products, they get assets under management, they charge a point or less on the assets under management fees to generate the revenue, and it's really easy. Once you've done one, it's easier to do more because it's all technology, right? You're using computers. So if you can now I can develop a $12 billion fund with 5 people instead of 50. Right? And I can do it faster now because I got big data analytics and I got computing power now that has gone through the roof. So now I can leverage up the technology and my people to basically pump out this product, get the assets under management, and we're making a ton of money because our overhead costs are infinitesimal. They're insignificant compared to the revenue potential. That's fintech. That's fintech. Okay? And that's where we are right now. Portfolio hedging and risk management. I take the derivative contracts and writing the forwards, writing the futures, buying the puts, writing the calls to hedge off downside risk within my portfolio. That's called portfolio insurance. Calculate the value at risk, and whatever risk there is that's unhedged, you basically use the derivative contracts to hedge off what's left of the value at risk to hedge off and use portfolio insurance. And that's through derivative applications. Okay. Structured products synthetics. This is called financial engineering, it's called quantitative finance, it's called financial econometrics. I'm not teaching that stuff in this class, okay, but you should know about it, all right? This is all econometrics, this is all calculus, statistics, computer programming, computer science, data analytics, okay? You learn this stuff, you can invent the product, you can build up risk management strategies. You can work for the bank, or the hedge funds, and the broker dealers, and anybody else that's trading in a family office or whatever it is. The structured product, this is product development and innovation. Okay. Same laws around marketing products, same for finance. Technical securities analysis. The book does a really horrible job of technical securities analysis. I have basically put up there all kinds of readings in technical securities analysis. It's basically momentum trading. You can use the RSI and the MACD from stockcharts.com. You can use we're going to use a 10, 30, and 50 day and 50-day moving average system. And we're going to back test the 25 stocks that you picked over a 3-year period. And I'll tell you right now, every single class, almost every single team that's applied this 10-day, 30-day, 50-day moving average system, on the $1 million that we theoretically gave them, they made $100,000 a year per year over 3 years. So $100 grand on the $1 million every year, every 3 years. So $300,000 on the $1 million, guaranteed. It's just a rules. When the 10 crosses the 50 and the 30 crosses the 50, you either buy or sell. If the 10 and the 30 don't cross the 50, then you hold it. So it's just a signaling system. There's no emotion whatsoever. We could program this in some application and then slap this as an automated trading system on top of a, through some kind of API onto some kind of broker-dealer platform and just make it a money machine if we wanted to. I probably should have done it, but I don't know. If you got like $1 million I can borrow, we could probably do that. Support lines, resistance lines. Support lines are on the bottom, resistance are on the top. Trends in the stock prices. There's serial correlation in stock prices. If stock prices go up for some time, they're probably going to continue to go up. If they've gone down for some time, they're probably going to continue to go down. So there's serial correlation in stock prices. Channels are when the stocks are basically trading in a range or moving upwards but trading in a range. That's a channel. There's flags, there's wedges, there's Dow theory, there's Markov theory, there's other types of technical trading systems that a lot of these traders use to basically trade their securities to enhance their rates of return. I'm a big proponent of fundamental and technical securities analysis. You combine the two together, it's almost a foolproof approach to trading, whatever it is you're trading. Homeworks we assign, Excel. You need to print out the Excels for the homeworks and show me the websites. So it's just moving through material. Statistical pretest, we got to go over that. Did I go over the first part of the pretest at all? Did I go over it at all? Pretest? Okay, you got to remind me to do that. I already went over some of it already. And some of you already have gone through it. Okay. Report and Excel templates for the static and passive stock portfolios are already up on the website. Okay. Derivative trading. I'm going to talk to the guy at the CME, okay, probably next week, because I've been setting up my classes. And then I'm going to have him call in and do a demo on the CME platform to trade derivatives. And we'll try to trade some derivatives off the platform and see if we can beat each other. So add in some kind of dynamic trading simulation into the class, okay? Because I did that last semester with another system, but they wanted to charge you $50 a pop, and I said, you're fired. I said, they said, no, it's going to be free. So we did it for a semester. They said, well, it's $50 now. It's like, I don't think so. My students need that $50 for beer. Licensing the SIE exam. Okay, if you're interested in it, you let me know. Okay, let's get started. Deliverable 1 is due on Thursday, March 14th. I have some examples of the deliverables up there. Okay, if you want to take a look at some of the reports that have been produced. Basically, the way the course works is we work on projects, we build on the projects, we present them and write up stuff individually, and then we roll them all up into a final portfolio trading system. Then we use that as the final deliverable product. Okay? So the class is really application oriented. It's a lot of theory. The book is you're gonna get the book from the presentations and from the take-home exams. There's no in-class exams in this class. It's all take-home. And then you just work through it. And then we do the best we can. If it's overwhelming or something, you tell me you need more time. You tell me, we'll set some expectations. And then what I usually do is at some point on Tuesdays, what I'll do is we're doing a lab. You guys need to work in your teams. I'll come around. I'll start coaching you. I'll be looking at your Excel spreadsheets. I'll audit them. I'll work through your strategy. We'll go through the optimization procedures. I'll walk you through that to make sure you don't screw it up. I'll walk you through the technical training system, and then I'll walk you through at the end. We'll be doing some intrinsic valuation work. That one of my students programmed the intrinsic valuation spreadsheet, which is really awesome. And I'll walk you through how to do that so that you have tools, knowledge, and you're actually producing stuff that's relevant, and important. Okay. Any questions or anything? basically the crash course. Okay. And I think I'm done, because I'm just totally burnt out. I could only talk for like 6 hours. All right, so on Monday, let's come in, let's do those presentations really quickly. Let's start building the portfolio, and then I'll start I'll help you with your pre-test and stuff like that, okay? The first part of the pre-test is pretty easy, okay? And then the last part is the exam for the 123, that's a little bit harder. I'll walk you through this. Okay? And then these homework problems that I gave you, the books over there, if you need a question, come in on Thursday, go straight to the board, and start putting up the solutions to the problems. And then what we'll do is we'll go around to everybody, and you'll walk us through the problem, and you'll walk us through the solution. Okay? So you don't have to go figure out the problem. Just go read the problem, figure out the solution, and then present the solution. Okay? Any other questions or comments? You might want to go take a look since you have some time. Those are the deliverable packages right here. If you want to see what some of these final reports look like. And there's some presentations over there.
Is it Mike
Yeah.